Good evening, everyone. I'm Neel Mathur, also known as Dad High School Researcher, as well as a junior at Hunter College High School. In this series of YouTube videos, I hope to take relevant and complex paper and make them more palatable so everyone is able to better understand them. Today, we'll delve into the fascinating question: does the stock market overreact? Our discussion will focus on the seminal paper by Werner, Bondt, and Richard Thaler, published in 1985 in the Journal of Finance. We'll cover the main ideas, methodology, key findings, implications, and limitations of their groundbreaking research. Let me give you a brief introduction to the paper. As I stated before, it was published in the Journal of Finance in 1985. This paper investigates whether the stock market overreacts to news and events. It integrates traditional finance theories with behavioral finance insights, representing a significant contribution to behavioral economics. So what is the research question? Well, it's do stocks that experience extreme price movements subsequently exhibit price reversals? Now, what was their hypothesis? Well, that the stock market overreacts to news, leading to predictable price reversals in subsequent period. This hypothesis suggests that extreme stock price movements are often followed by reversals, indicating an overreaction by market participants. So what was the methodology and data involved? Well, regarding the data, Bondt and Thaler analyzed stock returns from the New York Stock Exchange over 3 to 5 years. They focus on identifying stocks with extreme gains, winners, and losses, losers. In regards to their methodology, the study identified stocks with extreme performance and tracked their subsequent performance to test for reversals. The performance of these extreme performers was compared to a control group of average performers to determine if reversals were statistically significant. A control group was also involved. The control group consisted of stocks with average performance, providing a benchmark for comparison. So what were the key findings of this paper? Well, stocks with extreme past performance tend to revert in the following period. Loser stocks, those with extreme losses, outperform the market more than winner stocks, those with extreme gains. These findings support the overreaction hypothesis, suggesting that market participants overreact to news, causing temporary mispricing. So what are the implications for investors? Well, the contrarian investment strategies is impacted here. Investors can potentially earn above average returns by buying past losers and selling past winners. This strategy exploits the market's tendency to overreact. There's also a challenge to the efficient market hypothesis. The findings indicate that behavioral biases impact stock prices, challenging the notion that markets are always efficient. There are also some behavioral insights. Investors should consider psychological factors such as overreaction and sentiment when making investment decisions. There's also some criticisms and limitations of this paper, one of them being the sample period and data limitations. The findings may be influenced by the specific sample period and the data used, which could affect the generalizability of the results. There's also mixed subsequent research. Later studies have provided mixed results regarding the persistence of the overreaction effect, indicating that it may not always be present. There are also transaction costs and market conditions. Implementing contrarian strategies can be affected by transaction costs and varying market conditions, which were not fully addressed in their study. So what is the conclusion from this paper? Well, the Bondt and Thaler study provides compelling evidence that the stock market overreacts to news and events, leading to predictable price movements and investment opportunities. Behavioral biases, such as overreaction, can cause temporary mispricing, offering potential gains for contrarian investors. The paper has significant implications for market efficiency, investment strategies, and further research in behavioral finance. Thank you for watching this video. Please stay tuned for another exciting video by your favorite high school researcher. Goodbye for now.